Well, welcome everybody. Welcome to our BDO Canada Auto Marketplace update on COVID-19. My name is Michael Banks. I am the Marketplace Leader for the BDO Retail Consumer Business Practice, and I'll be moderating today's WebEx. Our Automotive Services Group is our largest single subsector in our Retail Consumer Business Practice, so it definitely deserves some special attention during these trying COVID-19 times. Our group services over 400 plus dealerships that include some very large dealership groups, both across the country and specifically within the GTA. Our experience includes many deep relationships with OEMs, dealer associations, lenders, and other stakeholders that we've been in continuous contact with throughout this crisis. And it's these relationships that have provided us with some very unique viewpoints and perspectives which we'd like to share with you all during this time to help manage and adapt through these COVID-19 challenges that definitely impact all of us. A few housekeeping points before we start. Now, I know the hot topic right now is, and it may actually be happening now as we speak, the updates from the government with respect to the enhanced 75% wage subsidy. Although we're going to be speaking a little bit to that point a little bit later on in the discussion, we do want to draw everyone's attention to an upcoming BDO webcast, actually part 2 of our cash flow and strategy series with respect to government incentives, which is being planned for this coming Friday at 2:30 Eastern Standard Time. It's going to be a tax-focused webinar scheduled for this Friday, and we're hoping to have more specific practical details to share with everybody because this is all being rolled out in real time. A link to that webinar we will be sharing towards the latter part of the presentation, as well as a few other links with respect to our BDO COVID-19 information panel, as well as some other hopefully helpful links that we can steer everybody towards. Our WebEx today will last approximately 60 minutes. We may go slightly over, but we're going to try and keep it to time based on the number of questions that we get. Please keep them coming. You'll notice, hopefully in the bottom right hand of your screen, there is a chat function. Given the numbers and the virtual format we're trying to roll this webinar out, we have to conduct our Q&A in a virtual setting. So please keep your questions coming. We'll try to answer as many as we can, but if I could ask that all questions be directed to all panelists just so we can filter them, group them together, and make sure they're directed to the appropriate speaker. Slight caveat that I'll add here, the information, especially with respect to the government incentives, is coming in real time. So the information and perspectives you're about to hear are effective as of 1:03 p.m. Eastern Standard Time right now, but it's subject to change. So here's what we know now, here's what we think, and also here's what we still have left to answer. So we'll be as candid as we can. Our advice and any commentary will be general in nature, but please keep your specific questions coming. If we either can't, given time or other limitations, answer your individual questions in a group forum during this webinar, we will reach out to you personally and give you whatever help you need. So without further ado, I'd like to introduce the panel that we've got today. First off, David Herzog will be joining us. He is a partner in our Automotive Services Group, as well as our GTA Auto Services Leader. Justin Master-Loangelo is a tax partner in our GTA tax practice. We've got Haley Van Vliet and Laura Gibbons, both are senior consultants in our HR advisory practice. I'll be helping Justin talk through specifically some of the government incentives programs that are available, as well as what we're expecting to come. As well as Clark Lonergan, who is joining us as a financial recovery and advisory partner and also a key member of our GTA Automotive Services team. And as well, Mike Lewicki doesn't have a formal speaking part, but is definitely a friend of the firm and an automotive consultant who's made himself available to help us answer any questions we may have throughout the WebEx. So without further ado, let's do a quick once over of the agenda. We're going to try and keep our speaking points to about 30 to 45 minutes with allowing time for Q&A all the way through as well as towards the end. We've got basically three key areas that we're going to touch upon. First, a current and forward-looking overview of the national and GTA auto marketplace in light of COVID-19. A review of the tax and economic relief measures that are both known as well as planned. And lastly, some observations and recommendations for our dealership recovery program. And as I said, just allowing some ample time for our Q&A. So without further ado, we'll start with our market overview and over to David Herzog.
Thanks, Michael. Firstly, I want to thank everyone on this call for taking the time out of your day to participate in this webinar. My name is Dave Herzog, and I am the GTA Retail Auto Leader at BDO Canada. So the last 3 weeks have been a very challenging and unprecedented time in the retail auto industry. Sales and service has essentially stopped. A majority of the workforce has been laid off, and the economic forecast for Canada looks bleak for 2020. We are all doing what we can to react to these changes, but suffice to say, it has and will continue to take a toll on cash flow and liquidity in the short term as well as in the long term. As a starter to our webinar today, I would like to provide a high-level summary of what we are seeing in both the present time as well as what we can expect to see post-COVID-19 shutdown. We have developed a placemat with a brain in the center, essentially depicting all of the thoughts and concerns of our BDO Retail Auto Group. As you can see, my brain has been 100% focused on COVID-19 for the last 3 weeks. Okay, so let's start with the present. At this point today, we are in an economic halt, and the situation is not looking great for Q2 or Q3. The financial forecasts for 2020 and 2021 depend completely on how long the shutdown lasts. Much like our neighbor to the south, we have kept dealerships in as an essential service, and this has awarded us some financial benefit and hopefully further benefit down the road with possible government subsidies, both coming directly as well as indirect. Right now, consumers are self-isolating, as we all are, and for the most part, they are not buying cars, and we do not know when the shutdown will be lifted to allow them to start buying again. Current modeling out there is predicting a 20 to 30% decline in volume year over year, with much of the drop coming in Q2 and Q3. However, not all brands, locations, and buying groups will be impacted equally, and therefore, variances in the estimates should be reviewed individually by store to determine the possible impact. The challenge we face is that there is constant flow of information on COVID-19, and it's unrelenting. That being said, we need to really focus on what is critical, and what is critical right now is cash flow and liquidity. Leadership and strategy should be fully focused around doing what we can right now to manage our current cash flow for the next 30, 60, and 90 days. Looking at such tactics as reducing expenses, deferral on loan payments, bank restructuring, and taking advantage of all government programs is essential. Furthermore, we need to put plans on hold around acquisitions, re-imaging, divestitures, capital acquisitions, employee promotions, bonuses, and so on until we have secured sufficient cash flow and liquidity. In the latter part of the WebEx, Clark will speak more to cash flow and liquidity. Okay, so we talked about the present. Now let's talk a little bit about what happens post-COVID-19 shutdown. When COVID-19 passes and we are clear to start socializing, buying cars, and working again, what will the retail auto landscape look like? Many auto analysts and industry groups believe that the landscape will surely look different from the one we left behind at the end of February. We do not have all of the answers yet, and quite honestly, a lot will really depend on the consumer confidence. That being said, I've outlined 4 significant factors that are sure to have an impact. Number 1 is consumer behavior. How will this change, if at all? And how will we react to this as an industry? Will we provide incentives, 0% financing, walkaway insurance programs, and/or other measures? Number 2, the mix of new and used vehicles. The used car market may fare better than the new car market in 2020 and 2021, and therefore dealers positioned well to take advantage of this may actually fare better. Number 3, the real estate landscape. What will this look like? Will there be an excess supply of land, or will there be less activity and therefore less supply? Number 4, possible changes in how the OEM and the dealer network work together. Some of the questions that come up are as follows. Will the OEM take another look at their model and maybe make changes? How will the incentive programs to dealers and consumers change? Will OEMs look to simplify a very complex model around incentives, programs, and CSI? And lastly, how will the OEM and dealer network work together to regain consumer confidence so that they spend money on vehicles? One possible thought that has been bouncing around is a coalition of dealers and OEMs across Canada working together on a nationwide strategy. Okay, so we know there's going to be some changes when we return to our new normal. But what can owners, management, and leaders do to put their best foot forward? The following is what I would outline as 4 critical next steps once we return to work. Number 1, revise cash flows. Once we are up and running, we will need to work through the revised cash flow, incorporating principal payments that were previously deferred, new cost structures, as well as changes to revenue forecasts. Number 2, future revised strategy around growth or divestiture. Was a plan to divest before this happened? And if so, how to react or restructure to get back in that mode if that is still the plan? What if the plan was to grow and acquire? How will this change on a go forward? Will there be more or less opportunity to acquire in 2020 and 2021? Well, much of this will depend on a number of conditions, including ability to obtain financing, multiples on valuations and real estate cap rates. Right now, we have very little information on valuation of dealerships and how it will be impacted in the long term. The only information we really have are valuations on the stock market for public auto dealerships. And we're seeing decreases anywhere between 25 to 35% in the last month. However, all indications are that valuations will recover. But again, it's a wait and see. Number 3, banking relationships and restructuring. Once the dust settles, no doubt the financial institutions will take a closer look at their own liquidity positions. Some questions that may come up are as follows. Will the banks ask for additional financing? What type of forecasting models will be acceptable? What types of additional reporting will be required? Will additional security have to be provided? And will bank terms change? Number 4, incentives and other OEM support. It will be extremely important to have the pulse on what the OEM is doing to ensure we are maximizing every dollar of money they're pushing into the dealer network. Maybe a full-time financial analyst is required to manage the incentives, as they are sure to be many. Again, it's a wait and see. No doubt there's a lot to digest here and a lot to think about in terms of our future impact on the next 3 to 9 months. For now, I will pass it over to Justin to talk a little bit about the taxation impact. Thank you.
I don't know if it's just me, but I'm having trouble hearing you.
Is that better there, Michael?
That's better. Thank you.
Okay, perfect. Yeah.
You're probably watching more now. Is he talking right now?
You know what? I was going to mention that. So as we get into some of these tax and economic relief measures right now, one thing that was actually just announced is that Morneau, he should be announcing more details on the wage subsidy here at 2 o'clock. Trudeau spoke at 11, provided a little bit more context. I'm going to get back into that in a bit, in a couple slides. So
perfect. First
off, I'd like to start by talking about some of the tax and economic relief measures. I'm sure many of you on the call are already well aware of many of these measures, but I think some of these are worth mentioning. Keep in mind that this is not an exhaustive list. There are some other specifics as we get into some of the changes at the provincial level that just aren't noted here, but we can circulate a more formal document that we've got prepared that kind of outlines and has an update on all of the changes. So first and foremost, the corporate and personal tax filing deadline has been extended until June 1st. This was relatively new on the corporate side and applies to corporations that were due after March 18th, so something to note. More importantly, I'm sure everybody's aware, but I want to bring it up as well, the corporate and personal tax payment deadlines have also been extended until September 1st. Now, this also applies to installments. So from a cash flow perspective, as Clark will talk about down the road in this webinar, this is big for everybody, right? So preserving cash is king. I'd encourage everybody on the call to really think about, should you be making your corporate tax installments? My guess would be no when you look at your cash flow projections. So definitely take advantage of some of these relief measures that have been introduced from the government. One interesting point to note on the corporate tax deferral is that it does not apply to Part 4 tax. So some of you may be familiar with Part 4 tax. Part 4 tax generally would be, if a corporation in your group received a dividend refund and you paid the money up the chain, the parent company receiving that dividend and potentially the dividend refund, that tax is still payable by its regular deadline. I know that gets a little bit technical, so happy to answer any one-off questions on that after, but you've got to be careful on which tax payments have actually been deferred. A recent change was also made to the HST payment deadline. It was also extended until June 30th. Keep in mind that as of now, HST filing deadlines have remained the same. And I think really at a high level, that's really for the government to keep a gauge on the economic activity in the country, to get a gauge on where sales are at, the activity within the country. So I think that's why they have not yet extended the HST filing deadlines. A few changes at the provincial level that I think are worth noting. From an EHT perspective, payments have been deferred starting April 1st for 5 months. And the EHT exemption here has actually increased from $1 million to $490,000 from $490,000 in 2020. Some of these other cash flow loans, I'm not going to get into some of the loans with the BDC and EDC. I'm sure you've heard of them before. If anybody needs a specific introduction to anybody at the EDC or the BDC on these loan programs, we'd be happy to do so if you just reach out to us. The one program I wanted to spend a little bit of time on was the Canada Emergency Business Account. This was announced, I think, last Friday, and the government's been pretty quick to act on the Canada Emergency Business Account. Banks have actually already started to reach out to their customers and clients on this loan, and you can actually apply directly through the bank. I bet many people on this call have already seen and noticed from their bank. Funds should be available relatively quickly. This is a nice quick hitter as it's a $40,000 interest-free loan. You're eligible for this interest-free loan if you've had payroll between $50,000 to $1 million last year. I know a lot of the banks are asking for your T4 summary, so that's one of the things they're going to ask you for. The kicker here is that 25% of this loan can be forgiven if it's repaid in full by December 31st, 2022. So a bit interesting for everybody on the call. I'd encourage you maybe to look at that measure as something to look at from a short-term, although be it small amount, but a short-term cash flow loan for your company. Now, I wanted to spend some time now talking about the $25,000 temporary wage subsidy. So we can go on to the next slide here. Although for some of the dealers on this call, you likely won't be eligible. So to be eligible for the $25,000 temporary wage subsidy, you have to be a CCPC with taxable capital of your associated group under $15 million last year. So that's who's eligible, and the government actually has a very nice frequently asked question, sort of bulletin on their website that really walks through this nicely. So what does this do? This permits eligible employers to reduce their income tax remittances by 10% of the remuneration paid in a specific period between March 18th and June 20th. Now, there are a couple caps with this reduction. One cap is a reduction of $1,375 per employee during that period, and a cap of $25,000 per employer. And a few other interesting points to note here: you cannot reduce your remittances towards CPP and EI, so you cannot reduce those remittances. And a quick example here, a lot of the questions we've been getting is, what's this 10% calculated on? So if I have 5 employees earning $4,100 a month for a total payroll of $20,500 in that specific month, that subsidy would be 10% of the $20,500 or $2,050. So that's how it works. I like this one personally because there's no application necessary. There's no process. There's no waiting period in terms of when you're going to collect the cash. You basically receive this subsidy by shorting the government on your remittances. A couple other quick questions on this one. One common question has been, if I'm shorting the government on employee remittances, does that mean they're going to be behind the 8 ball next year when they file their tax return? The answer to that is no, because the government's basically topping up the shortfall in the remittances in this case. Another question I've had here is that, is this remittance taxable? And it actually is. So keep in mind that, although it's a $25,000 subsidy, this will be a taxable subsidy in the year that you receive the subsidy from the government. A lot of different reiterations in terms of how you can go about calculating this. One point that I want to recommend everybody is just keep adequate support of your calculations. You want to make sure that you don't go above the $1,375 cap per employee or the $25,000 cap per company. So that's about it on the wage subsidy. I know it'll definitely be applicable for a lot of people on this call. Again, if your taxable capital was too high, unfortunately, you're not eligible for that subsidy. The wage subsidy that everybody's been talking about since Friday is the 75% wage subsidy. One interesting point, and there's been a lot of back and forth on this, but at this time, from the publications that the government has released, this 75% wage subsidy will not replace the 10% subsidy. Okay, so that's one of the interesting points on this wage subsidy. Now, to qualify, you must show a decline in 30% of your revenues. Now, what does that mean? At this stage, we don't know. We don't know if they mean year over year, month to month. We don't know how you're supposed to prove the 30% decline in your revenues. I would imagine that when Morneau speaks here at 2 o'clock, we're going to hear much more information on this wage subsidy. And as Michael mentioned at the outset of this webinar, we're hosting another formal webinar on Friday. We're going through this wage subsidy. We'll be going through that in depth. Now, I can imagine this probably has significant implications for everybody on this call, because from what we've been told, the government will cover 75% of the first $58,700 per employee of their salary. So really that equates to that $847 a week. Now when you think about this, right, who's eligible, one thing that Trudeau mentioned today at 11 o'clock, he said, this again is going to be for companies big and small, but he basically reiterated that this will be eligible for everybody who's not publicly funded. So I take that to mean everybody who's not a public company. But again, that's just my interpretation of it. More to come today. So we'll definitely see where that goes. And a lot of questions I've been getting from dealers and other clients, has been, if people have already been laid off, how does this affect things? And I think from a business perspective, that's where I'd start to think about this now. If I've laid somebody off, and then employees see that hey, the government's going to be providing a wage subsidy, does that mean I'm getting called back to work? Because if you do the simple math, the 75% wage subsidy equals more that an employee would get than if they were on EI, right? And another point that the government mentioned today was that, if you qualify for the emergency wage subsidy, you do not qualify for the Canada Emergency Response Benefit, which Laura and Hallie are going to talk about in a bit. So a few quick hits on the wage subsidy. I wish I had more for you, because I'm sure that this is an area that a lot of people on this call would like more information on. We will be doing a more in-depth discussion on this on Friday, so stay tuned on that, and we'll be happy to answer any questions at this time. So before wrapping up some of these tax measures, I wanted to talk about a couple of tax strategies that you can look at this time. Now, a lot of times, many of you on the call are probably familiar with an estate freeze. So an estate freeze, is when, you freeze the value of your companies and you pass the generation on to the next, you pass the value, the future growth onto the next generation. One topic that you've really got to be aware of at this time is called an estate thaw. So I look at this as almost like a once in a lifetime opportunity from a tax perspective. You always talk about estate DAWs, but the economy never dips enough that you'd really entertain it from a tax perspective. At a very high level, this gives you a chance to reset your estate freeze value at a much lower value, meaning that, effectively what this does is really offers you a significant reduction in your estate tax. So something I think you should consider looking at this time or over the next few months as you have an opportunity to reset that value. And the other one I'm going to mention is really timing of loss utilization and loss carrybacks. So in a lot of cases in the past few years, I'm sure a lot of dealers have paid tax, and this year you're going to incur losses. Well, you can carry those losses back 3 years and recover tax paid in those 3 years. Now, depending on when your year end is, if you've got a December year end, you may not be able to realize that loss carryback for a number of months. Depending on other business reasons, there's the ability to trigger a year end. If you have other business reasons to do so through an amalgamation or something of that nature, that may be something you want to entertain in terms of how much of a loss you're looking at right now and what that would involve in terms of carrying back that loss and the cash flow that would provide you going forward. I'm going to pass it off to Laura and Hallie, and they're going to speak to some of the EI measures that you may have questions on at this time.
Laura, I'm not sure if you're still on mute. Laura or Haley? Sure if we're having technical difficulty.
Hi, it's Hallie.
Oh, sorry. There you go. Go ahead.
Okay, so Laura must still be on mute. Can't hear her at all. So I will do her part. I'll do the best I can on the work sharing program. How's that? Unless you want to jump on, Laura, anytime, that would be great. So the work sharing program is essentially a program designed to avoid layoffs. So when there's a temporary reduction in your normal level of business activity, which is obviously what's going on in the world today, and it is beyond the employer's control for sure, the program is designed so that you can have a reduction in your workforce. And then what can happen is that for the duration of the week in which the employees are no longer working, they actually can have a supplement through EI to essentially top up their income. So this program is available to both federally and provincially regulated employers. And there's been some changes to the program. It is much easier to access right now. So the application process used to be quite cumbersome. It has now been adjusted to react to the COVID-19 pandemic situation. And so the process itself has been streamlined. There has also been some information set up, various websites and various phone numbers. And of course, there is a new email inquiry system that has been set up so that employers can directly email to an inbox that deals only with the work sharing program. So any questions they may have about the program and how it might relate to their employees and to them, and what kind of benefits would be available both pre-program and post-program to the employees, they can just submit those inquiries through the email. The other part is, as well, is that you can also submit your application through that process as well. One of the major changes to the program has been extended, because we're not sure how long this may last and how long work actually may be reduced for people. The program used to be 38 weeks in length. It's now extended to 76 weeks. And there's, if anybody had been originally a part of the program, because this is not a new program, like I said, it's just been adapted to address COVID. If anybody had been part of a program, there used to be a waiting period where you couldn't reapply. That has been eliminated as well. And one of the major things that have changed, and this is very recently, is that you used to have to submit a recovery program plan. in order to qualify for this benefit. That has been eliminated. I mean, I guess everybody's recovery plan would be the same and look the same, and it was quite cumbersome to go through the process, because essentially what you had to show in normal times when you had a downturn in business, you had to show the steps and measures you were going to put in place in order to rectify that and turn your business around. That's not the case right now, so they decided to eliminate that as well. So those are the basics of the program as it is right now. And like I said, it's much easier to apply for, and it makes it a lot simpler for employers to sign up for the program and get approved as well. I'm going to switch gears here a little bit and talk about employees that actually are not working and have, in essence, then lost their income. So the Canada Emergency Response Benefit, or the CERB, is proposed legislation to replace the emergency care and emergency support benefit that was originally proposed mid-March. So this provides a taxable benefit of $2,000 a month for up to 4 months for workers who lose their income as a result of the COVID-19 pandemic. So there's a number of ways that workers obviously could lose their income. So it would cover those that have lost their job, so perhaps been terminated completely. It would cover those that are still employed, but no longer working or receiving income. So that to me sounds like a layoff. It would cover people that are sick, quarantined, or taking care of someone who is sick. And it also covers working parents, so those who must stay home without pay, caring for children, usually as a result of a school or a daycare closure. The difference with the CERB is, other than the regular EI program, is that it not only applies to wage earners, it also applies to contract workers and those that are self-employed. And those two sectors there would not normally be eligible for employment insurance. A new portal has been set up, or in the process of being set up, where people can access this benefit. It says early April. We heard today that it actually is April 6th would be the first time that you could register for this benefit. Now, originally, again, they said within 10 days of application, you would get payment. The Prime Minister announced today that actually the CERB could essentially be 3 to 5 days through direct deposit from the time of application. One of the other pieces of this as well is that it would be paid every 4 weeks and be available backdated March 15th until October 3rd. So now I just want to switch a little bit again and talk about the regular EI benefits, sickness benefits, and the supplemental unemployment benefits. There is some confusion here and challenges with having two programs run at the same time, so I want to address some of those for you today. Regular EI benefits obviously are 55% of earnings to a maximum of $573. So in comparison to the CERB, those people that were actually able to max out regular EI benefits are losing about $73 a week if they're going to initiate the CERB program. There is still a 1 week waiting period for the regular EI benefits. It has been waived for the sickness benefits, so if you are sick or quarantined. However, the regular benefits, due to a layoff, a lack of work, or a reduction in work, it still has the 1 week waiting period. Now, the confusion comes in where employees were laid off, let's say at the 1st of March, and they already started the process for EI regular benefits. Okay, so there's a couple things that may happen. If those benefits have already been processed, then they will continue on with their EI regular claim. And then if it happens that they're not called back to work, so their time off has been extended past that 4 months, then they actually then could apply for EI regular benefits and do those back to back. You can't claim them at the same time, but you could do them back to back. Now, if they have applied and their claim has not been processed, what we're hearing is that those claims will automatically be rolled over to the new CERB program as of a certain date. I'm guessing it's as of April 6th. It's unclear. So whether you can actually have the CERB program along with the supplemental benefit program. I'll tell you a little bit about what the supplemental unemployment benefit program is. When you have regular EI benefits or sickness benefits, employers actually can register a supplemental program with Service Canada and give their employees a top-up. So you've probably heard of that. You actually can do that with regular EI or sickness benefits. So we've seen employers top up benefits to a certain amount. It can be anywhere from 55 to 95%. So anything above the regular 55 up to a maximum of 95%. And when you do that and register with Service Canada, the employee does not get any deductions from their regular EI program. So their benefits will not be reduced because of the fact that you're topping them up. Because in normal circumstances, if employees work while they're on EI, they will get a reduction in that EI payment depending on how much they work. With the Sub-P program, you actually don't get a reduction. What's still unclear about the difference between EI and CERB is that whether the employees can actually, the employers can actually top up the CERB benefit. It doesn't say one way or the other. The draft legislation does say that you can earn no income for actually 14 days. That slide is wrong. It's actually 14 days in a row. You can't earn any income or work. I don't know what any income means. It doesn't say whether any income could potentially be a part of that top-up program, but hopefully more details will come on that as well.
Great. Thanks, Hallie. There are a couple of questions coming in, Justin, from from your piece earlier, but just in the interest of time, I think we'll pass things over to Clark to talk through some of his financial advisory recommendations. And Clark, I think you are the keeper of the cash flow, and I think you've got some interesting insights and some best practices to share with everybody. So over to you.
Perfect. Thank you, Michael. Good afternoon. As background, a significant part of my practice has been dedicated to assisting dealerships and dealership groups and their lenders in managing through challenging business conditions. My automotive background includes non-public practice experience working out of Magna's headquarters during the last financial crisis. The conditions that we're currently facing are unprecedented, impacting all areas of our economy and testing the foundations of our social structure. The focus of my segment and the presentation will be on how we as business owners and managers can effectively lead our organization and the stakeholders through this crisis. The framework that we will use fall primarily under three phases: the assessment phase, the planning phase, and the implementation phase. Being proactive and not reactive is a mindset that business owners and managers need to utilize. Yes, times are uncertain, but we need to assess the variables that we're currently facing and plan accordingly as they change, being dynamic and adjusting. The assessment phase, identifying what should be keeping you up at night and actively planning to mitigate those items. Running pessimistic scenarios to your business plan to avoid the bad surprises. The planning phase, maximizing cash and available credit to buy your organization time and ultimately position yourself to be a buyer. Assessing the agencies of all your stakeholders and what they want or what they need. And finally, the implementation phase, lead your stakeholders through the process to maintain control. Too much information can be a bad thing. Before we dive right into it, let's summarize. Identify the risks and quantify what they mean to your organization. This gives you the required knowledge. Liquidity will buy your organization time. A well-thought-through plan and effective management of your stakeholders will allow you to maintain control. Now, if we dive into the primary focuses, the three areas are business risk management, liquidity management, and stakeholder management. So business risk management is basically taking an independent assessment of what are the key variables that impact your business plan that you normally do in November or whatever the Q4 is of the year leading up, and stress testing your business plan based on these variables: sales, impact of government incentives, and all the rest. The stress test is primarily a P&L focus and financial statement focus. The next side of it, and the most important side that comes out of the business risk management and the variables identified, is liquidity management. This next slide. This is critical to running your business during times of crisis. We want to assess your P&L on a detailed basis, understanding what costs can be cut, what payments can be delayed, and as I tell a lot of my clients, we want to bend as far as we can and not break. We need to be careful in determining the priority of which we pay our suppliers, employees, and other critical vendors. It needs to be a 360 viewpoint. Not paying rent, for instance, for those that do not have the real estate and the sister company, is critical and can be critical in the long term because your lease could become non-valid. And so once we come out of this, the dust settles. Not paying rent and being in a lease that is not valid can expose your organization to risk. So it's trying to take a bigger picture of what each payment means in the long term. And with liquidity management versus your monthly business plan is a 13-week cash flow, which is critical. To David's earlier comments about the viewpoint, the 30, 60, 90 days, a weekly cash flow is critical to identify inter-month spikes or liquidity constraints that can impact your business. The variance analysis from these weekly cash flows can allow you to continuously improve your business plan. As you move through and look at your liquidity on a weekly basis and you roll it forward on a weekly basis as well, you need to tie that back to your business plan to make sure that your long-term, earlier forecast still makes sense. The next and final piece of it is the stakeholders. Identifying the key stakeholders and assessing their agency and preparing the agency assessment for each of those stakeholders. Allowing and identifying who needs what, especially with your lenders, you're able to determine with a good thorough plan what the ask of the respective stakeholders are. So what we're seeing currently is the banks are not going to proactively go out there and help you. You need to go to the banks with an ask, and that ask could be turning off curtailments, could be delaying principal payments and interest payments, but you need to develop that ask in a holistic approach and provide your banks with a view, with a path forward that shows how all stakeholders are impacted, not just your lenders. So that ask is critical in making sure that we can lead our stakeholders through the process and not let them lead us through the process. So that's all I have, Michael, if we want to turn it over to Q&A.
Yeah, thanks, Clark. Very wise advice. We do have questions coming in. I'm going to encourage everyone to continue sending them across. That concludes our, I'll call it quasi-formal speaking points. What I'm going to do is I'm going to start filtering some of the questions back to our panelists. And the first one I'm going to direct to Justin, and this goes back to the enhanced 75% wage subsidy. The question is, to clarify on the wage subsidy, if the 75% doesn't replace the 10%, does that mean you can get the 10% no matter what, even if you don't qualify for the 75%?
Thanks, Michael. So I'll try to answer that the best I can right now, obviously not knowing the specifics on the 75% wage subsidy, which again, we should find out in the next 15 minutes. I think it might actually work the opposite, and I'll try to explain why. So I think the question was to clarify on the wage subsidy, if the 75% doesn't replace the 10%, does that mean you can get the 10% no matter what? And I think the clear answer to that is no. I don't think you can get the 10% no matter what. I think the 10% wage subsidy is still a function of your taxable capital as a group in the prior tax year. So again, if you had taxable capital in your group under $15 million, in your associated group, I guess I should add, under $15 million last year, you should qualify for the 10% subsidy. One point I don't know if I mentioned, but I'm going to mention now, is that if your taxable capital was under $15 million for an associated group last year, and let's say you have 5 stores, so employees at 5 different locations, you would qualify for the $25,000 subsidy at each of those locations. So my take on them saying that the 75% doesn't replace the 10% would mean that if you are a company whose taxable capital was under $15 million last year, and you do qualify for the 10% subsidy, you would still qualify for the 75% subsidy. Because I think what they're trying to do here is they're trying to encourage employers as much as possible to not lay employees off and say, you know, hey, I'll cover 75% of the salary, but I really want you, and I think Trudeau's words today were, in every effort possible, I want you to try to, top up the remaining 25%. And even in his words today weren't clear enough to indicate, like, do you have to cover the other 25? Can you just keep somebody employed, have the government pay the 75%, and that's it? And in that case, they're going to get more than they would on EI. I think that's a very good question. One of the questions that I have in my mind in terms of how this is all going to shake out. But effectively, if you are keeping somebody employed and you do qualify for the 10% subsidy, that would mean that the government's covering 75%, you're out of pocket for the remaining 25%, and on the remaining 25%, you should be subject to the regular remittances that you'd make to CRA. And on that 25%, that's where you'd go ahead and take again another 10% off the top, up to the $1,375 per employee. So a bit of a long-winded answer, but I hope I helped answer that question. Again, really looking forward to the additional clarity in this area coming later today.
Great, Justin. Switching gears a little bit, and I'm going to direct this next one to Hallie. Hearing from clients as they're trying to navigate towards these perhaps short-term and in some cases maybe long-term layoffs, is there any potential litigation risk that our dealership clients need to be mindful of and manage as they approach these programs and these planned layoffs?
Thanks, Michael. Short answer, yes. I'll talk a little bit about the layoffs just in general in Ontario. There is some legislation, as everyone knows, called the Employment Standards Act. That act actually is the one that talks about what a temporary layoff is in Ontario, the duration of that layoff, and the extensions that may be awarded there. So just in general terms, a temporary layoff in Ontario can last up to 13 weeks. So at that point, if you don't bring employees potentially back to work after 13 weeks, they could be deemed to have been terminated, and then you would owe all of the termination or severance or whatever other obligations you have to those employees. Now, there are some ways that you could extend that layoff period. So the temporary layoff becomes up to 35 weeks, so 34 weeks. And you could do that if you continue to pay benefits or some sort of income to those employees during that time. So for example, I talked about the supplemental program before, the benefit program. So if you were a part of that program and they're on a layoff for 13 weeks, you actually could extend it to that 34-week period. And then again, after that time, after those 34 weeks are up, those employees not called back to work would be in essence terminated and owed everything they'd be owed. Now, one of the things when you talked a little bit, Michael, about the legalities of it, obviously I'm coming at it from the HR standpoint, but we do know that all employers in Ontario really don't have the right, if you will, to lay employees off unless there's a formal agreement to do so. A lot of times we see those agreements in unionized environments with their CBA or their collective bargaining agreement, where it details out what a layoff is, how long it can last, and what the process is for both laying off and calling back individuals. The other spot you may see it, which we seldom do, I will say, in someone's employment agreement or somewhere in some sort of employee handbook or agreement that lays out the provisions of a layoff that lets people know that could. Now, having said that, we are in unprecedented times. And, you know, employers do not have choices right now but to lay people off in most cases. And so I see there being some leeway there as far as any legal repercussions of laying people off when you technically didn't have an agreement to do so. I would hope that the courts would be favorable to the employer in the fact that they're doing what they can to actually keep employees, because laying someone off is not terminating them. They are still your employee. So hopefully we'll see some favorable outcomes as far as the employer goes.
Excellent. Thanks, Hallie. And presumably that there's also some dialogue that our clients are having with their legal counsel about managing through short-term layoffs, just obviously to manage
Absolutely.
risk as well. Yeah, it goes without saying. So, okay, Justin, I'm gonna call you back. There's a couple of questions around the 75% subsidy. I'm gonna kind of combine a few of them together. There actually is one question wondering why your video is not turned on, but I'm not going to ask you to really comment on that one. I think my answer would be the same as yours, but question about the 75% subsidy. How will we get the 75% and when, and on what basis is it calculated? I don't know if we can answer that in light of what's the details that are about to be delivered, but are you able to take that one?
Yeah, you know what? Good question. Not much I can really add there, unfortunately, other than it's all indications are that this is a subsidy that you will apply for, and I think Trudeau mentioned that today at 11, that this is a subsidy that you will apply for, indicating that this is something that you're going to receive like cash for. So whether that's through a direct deposit, check, whatever the case may be, I just can't see the math working you know, similar to how the 10% subsidy works in the sense of you just shorting the government, right? So I liked that subsidy because it was a very creative way for them to put cash in your hands quickly. Obviously, there's a lot of moving pieces right now, and I think that is part of the reason why the message was supposed to come out yesterday, and I think it was just delayed because this is you know, something that I think typically would take months to you know, develop on the government side, and they're trying to do this in the span of a couple of days. And again, how you would qualify, still TBD. He made reference to all organizations, big and small, not-for-profits, partnerships. He just indicated that, you know, if you were publicly funded, that you would not qualify. I personally took that to mean if you're a public company, you likely wouldn't qualify. And the other criteria being you have to prove that your revenues dropped by 30%. I don't know what period that pertains to. I'm sure we're going to find out shortly. You know, is it year to year? Is it from January to March? All great questions. I'm sure we're going to have a lot of clarity. One thing I wanted to note is that, you know, and I kind of reiterated to this before, but one thing I want to note is that with this subsidy, he has said that this will be retroactive to March 15th. So that's a good thing, right? It's going to allow you as an organization to plan and understand what this means from a cash flow perspective. And I think one of the other big messages that as an organization you're going to have to start thinking about is on the optics side again, right? So if you're laying off employees, and if you know, human capital is, you know, very valuable these days. We all struggle to find very good people. So struggling with the sense of, yeah, who may I call back to work that'll take advantage of this subsidy? Because based on that math that they provided, covering 75% of the wages up to $58,000, you know, that employee that might put an extra, say, $1,300 in their pocket, as opposed to if they were going to apply for EI or the Canada Emergency Response Benefit. So I think that's where my head would be at in terms of, you know, how does this affect us from a cash flow perspective, or how are we going to handle this optically in terms of now everybody knows, right, that the government would cover some of the wages. So not sure that helps much, but I'll allow some more time for some other questions.
Yeah, it's what we know now, and we talked about it earlier, but just to reiterate again, we will be sending not only the slides and the recording of this WebEx will be available to everybody on this call, but we're also going to be sending a reminder link to our Friday Part 2 WebEx, which we're hopeful to have a lot more details and to really focus more on the 75% enhanced wage subsidy. So more to come. We don't need to speculate anymore. So switching gears for a sec, and you know, maybe Clark and David, you guys can maybe both chime in on this or decide who to take it. But going back to, I guess, our cash flow modeling and, just some of the questions we've been hearing, I guess, from clients and in the marketplace, just around maybe some short-term levers to both protect ourselves and manage our short-term cash flow. One question that's popped up is, for years we've maintained large sums of cash in our floor plan, bulk cash facility. To protect this cash, should we as a dealer now take it out to pay a dividend to my holdco or repay some loans for shareholders? How best to manage some of that cash that's on deposit in my floor plan?
Clark, I'll let you take this one.
Well, I was going to say you, David, but again, I think arguably that's a good problem to have at this point. If you're able to actually take liquidity out of the business, I think, again, without knowing particular circumstances of the specific owner of the question, I think any money that you take out of your business, you want to have the ability to put it back in, especially if liquidity is needed. And then if you do put it back in, is making sure that you do get it secured and everything else in the event that there is any liquidity crunch. So I think I'm be overly cautious in taking any liquidity out of a business at this point, and then especially with your floor line and what's required by your banks, and being proactive in making sure your stakeholders are aware that funds are potentially being taken out. So I don't know if it fully answers the question, but again, I think it's probably a good problem to have at this point.
Great. Thanks, Clark. Yeah, some specific questions are coming in, and we'll just suggest again, remind everyone, if you've got specific questions or if you need some specialized advice, just reach out to us individually. Carly's got the slide up here. That is a link to our COVID-19 information portal. We direct everybody to that site, and also within our BDO Canada website, there will be links to our Friday webinar. Carly, could we advance one more just to see the speaker headshots? There you go. So here again is the contact info. Everybody that, for those that have spoke on the call, so feel free and please reach out to us. We are here to help. And to answer a question that came in earlier, we will be circulating the slides. Some of them may be currently outdated, if more no, well, maybe in the next hour, but we'll do our best to update them and get them out along with a recording of everyone. So we are coming to time. So what I'd like to do is I'd like to thank everyone for participating. We are going to keep the webinar live a little bit longer, so questions are coming in. They keep falling off my window, so I definitely know I'm not getting to everything, but keep them coming. We will be sending off, as I say, answers to as many of them as possible, but the main point is we're here to help, and please reach out, and we're glad to do so. So on that note, I want to thank my fellow partner and panelists, and as well to the group of you for joining in. Hopefully this has been helpful, and we are in this together, and we will get through this together. So thanks for watching, and enjoy the rest of your day, everyone. Bye for now.